All right, well, welcome back at our final session. Hope everyone had a good lunch. We're going to kick off with remarks from Chairman Atkins. So, Mr. Chairman.
Well, thank you, Jamie, and good afternoon, ladies and gentlemen, and welcome back after a productive morning. So in just a few moments, Jamie is going to head up to the third and final panel of the day. But first, I want to acknowledge the Division of Trading and Markets for organizing today's program and thank our more than 24 panelists for bringing such insightful perspectives to it. Of course, before I move on to my remarks, I have to add the customary disclaimer to make our own compliance people happy that the views I express here today are my own as chairman and not necessarily those of the SEC as an institution or of the other commissioners. As our panelists underscored this morning, the U.S. options markets have grown remarkably in their breadth and depth over the past decades. Today, there are more exchanges trading more products, generating a dizzying amount of message traffic. So, for example, Oprah disseminates over 3,200 times more messages today than it did back in the year 2000. And a broad cohort of retail investors now participates in these markets with greater ease and at greater scale. Given all that they share in common, it's tempting to discuss the options and equities markets in tandem. After all, the two are deeply interconnected, and developments in one market can have profound implications for the other. But commonalities between the options and equities markets can also obscure important distinctions among them. As options markets operate according to their own conventions, so they merit attention on their own terms. Yet a sustained focus on listed options has eluded the Commission for some time. And thanks in large part to Commissioner Hester Peirce, I'm pleased that with today's program, we're bringing that stretch to a close. Now, I should note that this roundtable is neither a prelude to nor a harbinger of any options rulemakings in the immediate term. Rather, today's a chance to celebrate the strengths of our options markets and to recognize the important place that they have come to occupy in the broader financial ecosystem. Today's panel discussions also offer an opportunity for leading experts and practitioners to examine what's working, to identify where closer attention is warranted, and to consider opportunities and challenges that lie ahead. In that spirit, I should also like to acknowledge the important work that's taking place beyond the Commission's walls. Through the Listed Options Market Structure Working Group, or LOMSWAG. I'm not sure why it's not LOMSWIG, SWAG, or SWUG, but LOMSWAG. As I understand its members have come to call it, SIFMA and the Securities Traders Association convene market participants with sometimes divergent perspectives to discuss issues of mutual interest. That kind of industry-led engagement can be enormously constructive by helping to develop, socialize, and refine proposals before they make their way to the Commission for formal consideration. So taken together, efforts like today's roundtable and the ongoing work of groups like LOMSWAG strengthen our options market structure in ways that will keep it the envy of the financial world as it gains both volume and scale in the future. Which brings us at last to our closing session, and I'm delighted to turn things over to Jamie for a discussion on the growth of listed options, the associated challenges and opportunities that growth presents, and the issues that the Commission and market participants should consider in the years ahead. So I expect this to be a thoughtful and wide-ranging discussion, and I thank you all once again for being here and watching online as well. Please enjoy the remainder of today's program, and thank you all very much. Thanks. Off to you.
Thank you so much, Mr. Chairman. We will now hear from the final panel of the roundtable. In this panel, we will examine the growth of listed options, the associated challenges and opportunities that growth presents, and the issues that the Commission and market participants should consider in the years ahead. I'm joined as a fellow moderator with our Associate Director, Richard Hawley, the Orf Slayer. And we'll begin with brief self-introductions from each of our panelists, name, role, and your interest in the options market. So, Andre?
Good afternoon, and thank you. And thank you to the Commission for including the Options Clearing Corporation in this discussion. My name is Andre Bolkovic. I'm the CEO of the OCC. OCC, as probably many of you know, is the central counterparty to every listed options transaction. And we sit at the center of this market. We are deeply invested in its stability, in its health, and its overall growth. And, to the points made earlier, the growth has been remarkable. If we recall, the last time this roundtable was held was 2004. And at that time, the Options Clearing Corporation cleared just over 1 billion contracts to having cleared over 15 billion contracts in 2025. So that also shows us that the growth is a sign of a healthy and robust market. And it also places obligations on all of us, exchanges, clearing houses, market participants, to ensure that the infrastructure, the rules, and our culture keeping this market safe can scale alongside it. Thank you.
I'm Shelley Brown, Executive Vice President, Chief Strategy Officer at MIAX, also Chief Executive Officer at MIAX Futures. I'm honored to be here today with all of you. I think meetings like this among our peers are what moves the options industry forward. I'd like to thank the Commission for inviting me to participate, as well as all the organizers for putting this program together. I'd also like to personally thank Jamie and Richard and the SEC, at the SEC in particular, for the invitation to be on the panel and for your leadership in the Trading and Markets team. Today's panels have been incredibly informative and have really reinforced the breadth of knowledge that is typical of senior leadership across our industry. I've spent the last 15 years helping to build MIAX family of exchanges, and prior to that, I've held a number of senior positions across the industry, including roles at Peak 6, NASDAQ, PHLX, Susquehanna, and many years as a floor market maker on CBOE. I've seen a lot of change in the industry over my 45-year career, especially since my first role as a runner on CBOE. But clearly, we've come a long way since the first few exchanges were founded, and today's markets are radically different, but in a very good way. I believe the industry has done a tremendous job of building out the infrastructure to support modern markets. The entire industry should be congratulated for its efforts to build out a market that is the envy of the world, with deep investor participation and a resilient market structure, and I believe today will provide a strong foundation for future growth.
I appreciate the opportunity to be here, and huge thanks to the Commission for the focus on options markets. My name is Alicia Crichton. I work at Goldman Sachs. Amongst a number of roles and businesses that I'm a part of, I head our global options clearing business, and that's the perspective that I'm hoping to share today. I think as has been discussed many times throughout the day today, the growth in the options markets over the last few years in particular has been nothing short of extraordinary. And there's no better time to discuss how we can continue to maintain that momentum and ensure that the markets are future-proofed. So how do we continue to grow and ensure that the ecosystem is serving the needs of all who participate? My focus today will be twofold, really. One is to bring the institutional investor perspective, and two is encourage us to think about execution and clearing more holistically. Both are in equal parts fundamental to ensuring that we're paving the way for further growth, as well as ensuring stability and resilience. We think some market structure reform will provide the right incentives for competition, execution quality, and most importantly, risk management, and maintain the U.S. options markets as the preeminent market as they are today. Thanks, and I look forward to the discussion.
Good afternoon, and thank you for having me, and thank you to Chair Atkins for recognizing the work that LOMSWAG has been able to contribute to and achieve over recent years. My name is Ellen Green, and I'm with IMC, a global trading firm and market maker. We were founded in 1989 on the floor of the Amsterdam Options Exchange and have always combined trading expertise and technology, an approach that continues to define how we operate in today's electronic markets. We provide liquidity across equities, ETFs, and derivatives on more than 90 exchanges globally, and are an active participant in the U.S. options market, including both single names and index products like SPX. Options markets are fundamentally quote-driven. Market makers compete and continuously manage risk and quote across a wide range of strikes and venues, and that competitive quoting is what supports liquidity and investor participation. From that vantage point, we think carefully about how market structure impacts both quality and growth, as well as the overall customer experience. The listed options market has evolved rapidly in recent years, driven by innovation and increased participation across both retail and institutional investors. As we've heard today, the market continues to evolve, and the question is how to ensure regulation keeps pace while continuing to support this competitive environment that we're in with liquidity and resiliency.
Okay. Well, thank you, Jamie, and thank you, Richard. And I do want to thank the Commission for convening us today. And I also want to thank Chair Atkins, Commissioners Peirce and Ueda for their continued engagement and leadership on options market structure. For those who I haven't met, I'm Kevin Kennedy, Executive Vice President and Head of North American Market Services at NASDAQ. And I've spent 39 years in the markets, including my first 20 as a market maker and a specialist providing liquidity. And I've also had the opportunity to serve in industry governance roles, including currently on Andre's OCC board, as well as the Canadian Investment Regulation Organization, CIRO. Over more than 5 decades, U.S. listed options market has evolved into one of the most resilient and competitive market structures anywhere in the world. That success has been driven by deliberate design choices, trading on regulated exchanges, mandatory order exposure for competition, centralized liquidity, and a strong clearing framework. Those fundamentals have produced deep liquidity, tight spreads, and a strong price discovery that benefits investors of all sizes. I'm so proud of NASDAQ's role in this ecosystem, but I am equally proud of the industry as a whole. You know, as I look up and down my fellow panelists, to me, and the 2 panels before, it really is like a dream team. You know, I like to put everything in sports or just different competitive terms, and we have like a fantasy team that is incredible in this industry. And I think it's the collective whole that has made us where we are today. So competition among exchanges and market makers continues to power liquidity, while innovation in products and access has expanded participation. As the market continues to evolve, future growth, why we're here today, will depend on maintaining strong industrial-grade guardrails, preserving transparency, resilience, and, most importantly, investor protection. So growth reinforces confidence rather than undermining it. The opportunity ahead is not just continued growth, but sustained high-quality growth built on this strong foundation. I appreciate the Commission's stewardship of this market and look forward to a constructive discussion on how we support the next phase of the options market together. And before I use the term envy of the world, I really want to just say that the strength of U.S. markets is something we should all be proud of, but it's not something to take for granted. Sustaining this position means doing the work that we're doing that starts today, and obviously it's been going on for decades to get us here, but we want to do it thoughtfully, deliberately, and with investors firmly at the center. And with that, I'll pass it to Matt.
Thanks. Hi, I'm Matt McKenzie. I look after U.S. policy for Optiver. Optiver is a global market-making firm started by 3 options traders in Amsterdam 40 years ago this year. We're celebrating our 40th anniversary this year. We provide liquidity around the globe, and we do it through a combination of human capital and technology, much like Ellen described at IMC. One of the core values of the firm is that we improve the market, and that has multiple dimensions. It means we improve the price and quality, but we also take very seriously the responsibility to think deeply about market structure issues and offer our thoughts about ways to improve the market through a policy lens. So that's why I'm so excited to be here and to have been invited to participate. So thinking back 2 years to a conversation with Commissioner Pierce when she asked if it would make sense to do a roundtable like this, it's a real pleasure to be here, and we're excited to continue the conversation. So thanks, Jamie, and thanks, Richard, for holding this.
Thank you. Hi, I'm Ferris Metallica from Charles Schwab. I run trading operations. We oversee about 47 million customer accounts across our retail, self-directed, and RIA businesses. We are seeing firsthand a dramatic increase in options, as noted today, trading from our existing clients, but also a substantial increase from new clients. As Commissioner Peirce said, the pie is growing. We're seeing a lot of entrants in the market. Also, our younger investors are adopting and utilizing options at a really high rate. Our approach to clients trading options has always been about focused on client education. And as JJ said, it's free education. Whether you're an advanced or a beginner, we customize education to your needs. We provide a best-in-class trading platform with features that help clients manage their own risk, and also parlay that with an interactive client service model that is staffed with options specialists so they can help clients answer any client's questions. So as mentioned, this is really an exciting time in options trading and really a timely roundtable discussion. I thank you for the opportunity and look forward for our discussion.
Well, thank you for the opportunity. I'll be brief. My name is Dmitry Muravyev. I'm an associate professor of finance and the Hewlett Research Fellow at the University of Illinois Urbana-Champaign. I wrote many papers about option microstructure, including studying option trading costs, option market makers, and retail trading, and I'm happy to provide the academic perspective on those issues.
Hi, I'm Jim Toes. I'm President and CEO of the Securities and Exchange Association, also known as STA. I want to thank Jamie, Director Sowe, Richard, and the Commission for organizing this roundtable. Roundtables and House hearings play such a vital role in the rulemaking process. It's an opportunity, obviously, for the presenters to kind of get very tight and organized on their thoughts and on their opinions, which provides a lot of value for the industry to then play off of. The STA is, our members are individuals who are employed in financial services. They're not firms. Our members are individuals. We have 16 affiliates in the U.S. and 4 up in Canada. It's a diverse group, both by geography and also by the roles that they play in the marketplace. We do maintain a listed options committee at STA. Very proud to say that of the 23 business firms that were represented on this panel, 21 are also members of that committee. The other 2 will be getting sponsorship packages tomorrow morning. The perspective that I'm, just to play off some of the previous remarks here, the perspective I think that I'm trying to bring here is, prior to STA, I was on the equity side, 20 years, Merrill Lynch. And I can't impress upon everyone enough that, this is a different market structure. This is like, if you're learning a new language and someone asks you a question in French, the first thing you're going to do is you're going to translate it in your head, what the question was in English, think of your answer in English, and then try to respond in French. Forget it. You have to just really appreciate the fact that this is a different market structure and it deserves its own view from that perspective. And the last thing I'll say, too, is, listen, I just want to say thank you to all the people on the LOC committee because they've been very patient with me for the past 10 years on taking an equity guy and teaching them, about how the options market structure works. It's a really cool ecosystem. My years in equities, I never saw market makers, exchanges, clearing firms, vendors, clients, all in a room, trying to, make the marketplace better. We are all guardians of this marketplace, and I think that the folks in listed options are really exemplify that.
Thank you to the Commission and to Jamie and Richard for the opportunity to participate today. It's a privilege to be a part of this conversation. I was hoping you guys were going to have a 4th panel about shoe companies transitioning to AI companies, but we'll save that for another day. I'm Mike Tracy. I'm the Vice President of Risk at Apex FinTech Solutions. We're one of the largest independent clearing firms serving retail investors. We cleared over $1 billion in options contracts in 2025 across 220 correspondent broker dealers. So when we talk about options market structure, we're talking about the plumbing that our clients and the customers depend on every day. My focus in the option space is what I see as the defining operational challenge of this era, the secular shift from start of day, end of day risk analysis to a world that demands continuous 24/7 risk monitoring spliced into smaller intervals. I look forward to discussing these topics with you guys. And my background is as a volatility arbitrage trader, so I come from a unique perspective, risk-taking to now managing a lot of the trades I used to expose in the market.
Thank you. We'll begin our panel with our first question, focused on the challenges of growth. So as we heard this morning, we now have more than 20 registered options exchanges, 18 currently operating, and are well over 1 million series. Efforts at strike mitigation and harmonization are counterbalanced by expansions in short-term options and new options. Market participants have done an admirable job of keeping up with the enormous growth of options. So reflecting on this remarkable growth trajectory, what options market structure concern keeps you up at night? Let's start with Kevin.
Thank you, Richard. You know, I love to say when I'm in front of other panels or even at work internally, like, nothing keeps me up at night because we have such a great team, et cetera. But honestly, there are two things that really do keep me up at night because I live, sleep, drink, eat options, just like JJ and so many other people in this room. And systemic risk bothers me. I've seen it go bad in the past with us. As good as we are, we've had issues. And with all the extra interdependence that we now have, and with more exchanges, and with more quotes, I'm concerned we're not paying enough attention to it. So when I answer some of these questions today, I want to focus on three things. I want to focus on reflecting on how we got here, and then highlight maybe some concerns, and then offer constructive criticism or maybe a way to execute. So for this one in particular, with what keeps me up at night, I don't have the solution with respect to resiliency. I mean, we've been resilient, but it's coming, right? Whether it's how it comes, we won't know, but we're becoming more and more interdependent every day with zero DT. I mean, everything. We all know. So I'd say I want to highlight that for the commission and figure out collectively how we can improve there and make sure that when something does happen, we all understand what the other exchanges are doing, what phone call we're going to get on, what happens at 3 o'clock, what happens if this happens at 11 a.m. So I would love to see some highlight of governance there. So then I want to just jump into, because you may not come back to me, I do want to add 2 or 3 other things. One is which those things keep me up at night. However, as I've said in my opening statement, this is an incredible product that we have, and it's really a treasure, but there's always room for improvement. And I'd say 2 things we could probably all 3 panelists and almost everybody in the room, and I think even you and your staff could execute on, is the penny pilot, the penny program, I guess we call it now. As we see that we're now trading 8,000 securities, I think there's room to do more. We're hearing from clients that we would love to see step on the gas a little bit on getting things into the penny program. So I think that would be something we could all execute pretty quickly. And then the other thing we hear, and I know CBOE has done exceptional work already on this, but the position limits, like they're clunky, and even when we finally get them approved, I think we still need every single exchange to file in order to affect them. So the 2 things I'd like to highlight that I think we can execute on pretty easily would be, let's take a hard look at the penny program, and let's take a hard look at position limits, and maybe just again with my sports analogies, but I like to move the chains. Let's just keep moving downfield. So I don't want to take up too much time.
Thanks, Kevin. Alicia?
Great, thank you. I'm going to take the question in 2 ways and probably a little bit different to Kevin. I actually do have a long list of things I worry about at night. The kind of couple of places I'll focus on here, I'll start with execution and then I'll make sure we cover clearing as well. I think, one of the things that we worry about is how do we ensure that we're servicing our institutional client base and focusing on what are their needs and what are they coming for us to do and what are the ways that we can service them. And we think one of the most significant impediments to being able to service that part of the ecosystem is the current structure around the 60/40 rules. And that, I'm sure everyone in the room knows, but it mandates that when an order goes to the floor, market makers are guaranteed 60% of that and a last look by simply matching on price, which means they're not price improving. And when we think about our role and what we're doing, we're providing a number of services, trade ideas, research, risk management, we're intermediating, we're providing capital on many of these trades. And so we think by allowing that 60% to automatically trade away, it disincentivizes us from providing what we think is much needed liquidity to the investor community or institutional investor community. This rule is over 25 years old. It came out in a very vastly different market environment where liquidity was a problem. We traded fractions of the volume that we trade today. And so we encourage reform to ensure that markets are fit for purpose for the institutional investors. Excuse me. On the clearing side, clearing capacity is an area that many of us focus on. A few things, excuse me. Sorry, it's clearly a passion project. Options clearing capacity for market makers continues to be a topic of discussion and concern, whether it's for market makers, whether it's for institutions, for the growing ETF ecosystem. And we think about the resources that we provide as a clearer, they're extraordinary, right? Whether it's balance sheet, capital, funding, liquidity, that list is extensive, including the technology it takes to support those flows. As this group knows, our job as a clearer is to stand in and guarantee the performance of the firms that we bring to the ecosystem. So meaning the model is based on one where you capitalize and guarantee the risk that you bring. And so we think that actually the OCC rule filing to reallocate the default fund based on risk is appropriate, and we fully support it. And so while we've innovated a lot on the exchange side, it's important to think about the protections for clearing firms, and I don't think they've kept pace with the risk in the market, and so that's something that we can hopefully focus on later in this panel, and hopefully I'll catch my breath.
Thank you, Ellen.
Thank you. As we heard earlier, the options market structure has been very effective in promoting competition across both market makers as well as exchanges. Competition in the exchange space is driven by meaningful differentiation, new models, new functionality, and real innovation, which is positive for the market. At the same time, the current structure continues to incentivize exchange entry driven by the linkage plan and the requirement that options be traded on exchange and cleared through the OCC. And just to pause the work, Richard, that the Commission has done on ORF has been many years in the making, and just congratulations on getting that across the finish line. So as we do look at our exchange venue with 18 exchanges, new launches coming, each additional venue increases fragmentation. As we heard in the first panel, there was a lot of focus on what the cost to those market participants, market makers might be. But if we think about it from a different lens, being a market maker requires that we connect to each exchange, process additional market data, maintain quotes against more order books, and allocate more capital more broadly to remain competitive. We see similar pressures in market data with continued OPER growth and in clearing, as Alicia just discussed, as capital and activity becomes more distributed. This creates real operational and infrastructure complexity at scale, and those costs are not optional. It further introduces growing compliance complexity as exchanges take differing approaches to rules and their interpretation, creating ambiguity and requiring firms to navigate nuanced and sometimes inconsistent expectations across venues. So what keeps me up at night is whether the incremental benefits of additional venues continue to outweigh the very real costs they introduce. The question going forward is how to preserve the benefits of competition while encouraging the kind of innovation that adds real value and ensures the market remains efficient and resilient as complexity continues to grow.
Thank you, Ellen. Jim?
Well, I think listen, I know we talked about operational capability. Our markets also run on investor confidence. We rely on that. If investors lose confidence in the marketplace, it's never a good outcome. I think where we're concerned, we've heard some talk about, account takeovers and the proliferation of strikes. So I just want to tell you where we're kind of focused on this. Account takeovers, first off, this isn't new. Account takeovers it's not a new phenomenon. They have been occurring for decades. Obviously, with the advancements of AI, they're occurring much more frequently and much more sophisticated. Then account takeovers, it's not just an option-specific problem. Account takeovers where the money is being moved from a legitimate account into a fraudster's account. It's occurring in ETFs and also equities. FINRA's doing an enormous amount of work on this. Raquel touched on it a little bit earlier, but I really would encourage you to, kind of understand the amount of work that they're doing in this area. They've carved out a lot of trust within the industry where there's a lot of information sharing taking place on it. When you look at the data that is there on account takeovers as pertains to options, it's occurring in these far out of the money strikes, where there's no open interest and no activity. That those conditions obviously create the opportunity for a fraudster to interact with the account that they have taken over by directing orders to a particular venue. So it's also worth noting too that this activity is very hard to pick up because a lot of it is occurring within that widespread or slightly outside of it. So it's hard to detect it. So really, obviously, the only way that we can kind of see this improving is on the prevention side, preventing these 30 to 50% strikes that that have no volume, that have no open interest. I know the OLPP has with the most recent amendment, there's a form that's been put in place that allows exchanges to sit down and talk about this more freely than they were allowed to before. We look forward to that. It's a very positive step. We look forward to engaging with that, but this is an area that we're most concerned about.
Can I maybe just add one more point to that? Because we deal with those account takeovers all the time. I think the strike mitigation helps. I do think there has to be, and you asked about what policies or frameworks that we can add. I think a framework similar to clearly erroneous, where trades can be broken customer to customer, that is, in addition to the strike mitigation, that's really crucial to stop this fraud from happening. So just want to, and that doesn't keep me too much up at night, but maybe 2 a.m.
Thank you, Ferris. Shelley?
A few things. First off, I agree with Kevin on the systematic risk, something that keeps me up. And obviously, things are a function of testing and efficiency, but it's something we're always concerned about. Another one is the strike listings. We talked a lot about that already. I would like to clarify for folks in the room, those that aren't aware, we talk about 1.5 million listed series. It all depends on how you define a series. Is a series the 850 call or 850 line with the call and the put? We have 1.5 million options, and we talk about a large percent of those options don't have open interest. You have to keep in mind the out-of-the-money puts that have open interest, the in-the-money calls don't. We have to take that into account, but at the same time, we need to be able to clear the way the exchanges can work together without DOJ interference to talk about listings. The thing that keeps me up most, though, is our obvious error rules. I think we've done a good job coordinating with the SEC across all the exchanges, having harmonized obvious error rules, but there's a serious lack of flexibility. Everything's predefined on how we act and how we react. The problem is we can't define everything in advance that could possibly happen. I go back to 1964 case that was at the Supreme Court, and Justice Potter Stewart said about a case that involved pornography. He said, I can't define it, but I know it when I see it. And it's really the same thing that applies to obvious errors. You look back, whether it be a customer account that was stolen and the customer trade needs to be busted, or there's so many different things that can happen. We can't define those in advance. I think we really need to readdress obvious error. The guy that did nothing wrong should not be forced to lose money.
Thanks, Lee.
I just want to do
Kevin,
one
quick
follow-up quickly. When I talked about systemic risk, I want to be clear. First of all, having 18 exchanges, I think we're in excellent shape as far as handling investors when MIAX has a problem or NASDAQ has a problem or CBOE has a problem. What I'm looking for to highlight is governance and transparency about what the playbook is, the procedures when something happens. So that's what's keeping me up at night, like that we're not communicating and don't have a central sort of repository to understand what the playbook is.
Thanks, Kevin. We'll turn to the next topic, which is going to be market makers and capital. So as we heard from this morning, displaying a continuous quote across so many series and exchanges is not for the faint of heart. We've seen some large firms exit the business recently and some new firms enter. One challenge market makers face is securing access to capital from an increasingly smaller number of clearing brokers, some of which are owned by bank holding companies that themselves are subject to evolving bank capital rules. What challenges are market makers and clearing brokers facing today, and what can be done to help facilitate solutions to those challenges? I'll start with Andre.
Thank you. And I think, a couple of panel members pointed out the clearing capacity is a concern. And having been myself both on the clearing broker side and on the market making side, there is only a few firms that can actually support market makers, and especially as it relates to index market making. And that has been the case for a while, and it would raise concerns in a catastrophic event, who would be able to absorb any new market entrant or even the entrants that are there today. We've seen stable clearing membership across the OCC in terms of absolute numbers, but the capabilities and the capacity to support market makers is fairly limited. Luckily, we are seeing some new market entrants entering the space, which I think is also supported both by the OCC as well as some of the other clearing firms who do not believe that it's beneficial for the industry to have this concentration. On the OCC side, we definitely want to make sure that we manage the risk as efficiently as possible. And we do continuously see where we can improve our margin models to make sure that we calculate the risk as appropriately and efficiently as possible. We do offer different programs to manage some of that risk through an escrow deposit program. We're looking to improve our current approach on paying interest on margin. So we are trying to see how we can support the industry. And being a qualified CCP, we do offer benefits to the banking community in terms of the risk-weighted assets that they have to hold against a central counterparty like the OCC. And we do also believe that we are working with other CCPs to see where we can make sure that our operations are efficient across the board, that the cross-margin agreements that we have are as appropriate as possible, to make sure that the industry can continue to develop at a safe and growth space.
Alicia?
Thanks. I think, if we focus on some of the challenges in being a clearing member and providing clearing capacity in particular to market makers, are sort of like the two sort of broad buckets that we think about it in are, one is operational risk, and that covers a number of different areas. And the second is bank capital, and what are the requirements as a GSIB that we need to hold in order to be able to facilitate that. And I think directly correlated to the growth in the options market is the demand for clearing capacity. And it's not just in options, it's actually in every product that's cleared, and also in products that are coming forward in order to be cleared, so treasury and repo. And we think about what are the operational risks. And I think it's almost been implied in the market that clearing is a utility service. And I think we have to think about that a little bit different on the forward. When you think of the volumes that trade, the pace at which trading is done, I think you said you're averaging 70 million contracts a day. That's one market in the U.S. Granted, it's across a number of different exchanges, but that's one market, and many of us are clearing across a number of different markets. So we are, as we stand in and provide that guarantee, it's very difficult for clearing firms to be able to define the capacity that they want to provide. And so we're sort of implying that we would provide unlimited capacity and unlimited guarantees to clear and settle a market maker or any firm's activity that we are signed up to clear for. So I think starting to think about what are protections for clearing firms? How do you define and size the capacity that you're willing to provide? I don't think the view should be that it's unlimited, and how does the ecosystem come together? And Shelley, you mentioned like the obvious error rules and the catastrophic obvious error rules, thinking about coordination. What are some additional checks that need to go into the gateway and ensure that we're preventing these types of errors before they happen? What are some things that we can do to coordinate around the industry where there's consistent tooling, maybe portals? There are things that we can do and self-solve for that would reduce some of the catastrophic risk that a clearing firm can face. And then on the capital side, clearly the Basel III reproposal, as we spend time thinking about, what are the implications? There are clearly some benefits that we see in terms of the recognition of netting. Andre, you mentioned some of the cross-margin programs. I think we were long disadvantaged of cross-margin programs, gave us the ability to recognize risk offset in margin, but we were never able to take those benefits in the capital rules. So having the ability to do that going forward, as we kind of evaluate what's in those rules, we may have more feedback as we continue to dig through them. That is certainly, a helpful step forward. But I think, the amount of liquidity that we provide in order to be able to facilitate the trading on these venues around the globe is significant. And so just thinking about some of the protections and some of the things that we can self-solve as an industry and kind of bringing together the advancements on the execution side along with the clearing side help bring that much needed capacity here and to other markets where we clear.
Thank you. Matt?
Thanks for the question. So I think it's been discussed a lot, the challenges that market makers face in terms of the costs and complexity of these markets, from market data to connection fees to everything else. But there are also constraints imposed just by virtue of the need to use the balance sheet of a clearing bank to access a cleared environment. And those sort of externalities come from the bank capital rules themselves. And this market is moving so quickly that one of the things that Optiver had to do in order to deal with that was apply a fair amount of resources, both human resources and technology, to build our own data visualizations of our clearing partners' risk-weighted assets. And when we're getting close to those constraints, we have to modify our behavior in the market. So we're not behaving in the market the way the supply and demand signals might suggest. We're doing it in order to maintain the RWA measures that our banking partners have. And I do think, the Basel III reproposal that Alicia just mentioned, it's encouraging. I'm no expert in prudential rules, but most prudential rules, in my experience, were not written with trading firms in mind. So I think the devil's in the details on that, and we'll see where that's headed. But it is encouraging that that proposal is out and that it has taken a step away from the original version. I think pretty hopeful that we could see that rule be finalized in the next year and a half, and that may help to alleviate some of the constraints that I described before, so we can get into the business in a day-to-day way of providing liquidity to these markets.
So before we leave market making, I wanted to ask, the definition or maybe lack thereof of bona fide activity has come up in the equity context. Is there anything in the options world we should be doing with that definition?
Well, there's something you're already doing, so I'd like to extend thanks to Richard and his team. There's engagement between trading and markets and the PTG on the bona fide market maker exemption to Reg Show. And one aspect of that I don't know that has been discussed that much is as we're exploring this new world of a tokenized security, one of the challenges for bona fide market making is the locate requirement for a hard to borrow security. If it's tokenized, is it going to be locked up and basically impossible to borrow? Like that's a ripple effect that maybe needs some further consideration, more time than we have on the panel to discuss. But there are definitely constraints to that hedging aspect of any market maker's business.
Thank you.
Now we'll turn to single stock weekly series. So some exchanges have proposed expanding the number of short-term options weekly series on single stocks. Unlike for index options, that raises unique issues like assignment after the 4 p.m. market close or corporate action or earnings news, including for related stocks. Is there a balance to be had between offering customers more single stock expirations and the risks and burdens that additional series place on liquidity providers and market infrastructure? And if so, where do you draw that line? Let's start with Ferris.
Yeah, thank you. I think maybe taking a step back, and I think to Ellen's point, like the exchange competition today in the environment where, vying for more volume is creating this dynamic of innovative products that we haven't seen in a long time. That's a good thing, right? But I think as with any new product, we need to move slow and methodical just to assess any potential unintended consequence. So, but specifically to to those Mondays and Wednesdays, these started in late January. We are seeing strong adoption. I think Ed mentioned that. I think we're seeing that, industry-wide. I think the PDT, updating and modernizing the PDT rules is going to probably increase that. So the indication is that'll grow even more. The liquidity, to your point, has been robust. We've seen tight bid-ask spreads. I think one thing to note out here is, NASDAQ did a great job listening to the industry. Thank you, Kevin, for not listing these on earnings. But I think it was talked about in the second panel there. But news comes out in non-earnings cycles all the time, right? So we've seen that the chip, China ban and the AI disruption as well. So I think I go back to operational risk and proving that operational risk, right? So I think most firms and retail specifically, and I think Stephen mentioned that, we need to keep the pace, right, with this innovation. And by that I mean we need to upscale firms' intraday capabilities and monitoring for expiration and assignment risk. Like, for example, like firms and maybe, retail firms may manage throughout the day to have maybe a 5% move on the options on Qs or SPY for the assignment, potentially a move after hours. You extrapolate that to single stocks, we could see a 20% move. And some firms maybe have a different approach to force close. Maybe we don't do that, for example. But I think the key is that increase in scope is substantial. That's hardware, that's faster systems, that's potentially more staff, risk staff to monitor. So I think so since these started trading, I think we haven't seen an event to really pressure test these capabilities until we kind of move to adding more names or even more days. So we need to prove that. So the last point I want to make, look, we've created so much confidence with the retail and the options market over the years. I think all it takes is one adverse event or a headline event that could really erode that trust. So I guess I would say let's move slow to go fast.
Thank you. Mike?
Yeah, so first and foremost, Apex fully supports expanded expirations. But we are already seeing issues. One of the hallmark conditions by which these companies to list Monday, Wednesday was that they do not report earnings on that day. What did we have happen yesterday? Amazon came out and announced earnings for Wednesday. So one of the key conditions by which this listing was approved has already been broken. Additionally, I am concerned about broker-dealers and retail who are disadvantaged in the after-hours cycle for contra decision-making. So many broker-dealers, the cutoff decision is at 5:30 Eastern, but many broker-dealers require their customers to submit their decisions by 5 p.m. Now, this gets very tricky with single stocks and with earnings volatility because you often have earnings announcement right after the close at 4, and then you have conference calls often starting right at 5. And so there's two tremendous catalysts there that can cause stocks to swing back and forth. And my worry is that you're going to have retail traders that put on seemingly low risk debit spreads, and they end up forgetting to exercise the long leg of their contract. I think there are ways to work around this. I think that if we considered potentially changing that 5:30 cutoff and reduced 90 minutes of aftermarket volatility down to potentially 30 minutes, I think that could be helpful. But I just want to make sure we all, again, let's run before we walk on this, because I think it would be unwise to roll this out to 50 securities in the next 6 months and have us trading Monday through Friday.
Dimitri?
Let me offer a somewhat independent perspective on this. First of all, I think that the individual stock weeklies is a great idea. It's a part of the trend for shorter and shorter options, which really fuel the growth of them. But I think as we shift to shorter and shorter maturities, the trading costs and best execution becomes ever more important, right? For two reasons. First of all, the holding periods become shorter and shorter. For example, I find that the retail investors in those kind of short-term options, they hold position for about 1 hour. So if you rotate your positions faster and faster, trading costs are important. And also with shorter maturities, option prices become lower, which is part of the attraction for the retail investors. And as option prices become lower, then the relative bid-ask spreads become higher. So for example, typical option price will be below $1, so a 1 penny tick size becomes binding. So if we think about the best execution in the option market, there is really not much public data. So the SEC report today showed that the effective spreads remain relatively stable in the option market, even though in the stock market in the last 20 years, the bid-ask spreads decreased. So this highlights the need for some kind of like a public disclosure. In the stock market, we have the Form 605. In option market, we largely have nothing. This is especially important for retail investors, right? So for example, a typical retail parent trade would be around like slightly under $1,000. And if retail investors execute well, they will pay $5 or less on that $1,000 option trade. If they pay the entire effective spread, they will pay $25 or so. I think it's important to educate investors not only about what a butterfly or iron quarter is, which I think in the industry did very, very well, but also about the trading costs. What we find in our research is really individual investors, so they make decisions whether to submit market orders and limit orders, and they do a very good job. Some of them do a very good job, but some of them don't. So I think it's important to highlight, educate retail investors about those trading costs, and those trading costs become ever more important with shorter maturities.
Kevin?
I thought Dimitri said that well, but then I also think of what Faris and Mike said, and they're in the trenches. Like they're there. But now I want to do like the reflection that I talked about earlier. I think the staff took a very long time to approve us for single stock, and I think that was the right thing to do. And I think we got it right. We're seeing that even with normalizing the volume, that it's accretive. So I think we've had a really good experience so far. One of the things I like about moving measured and deliberately is that you learn, right? So we learned something in the last 24 hours. We learned that that can happen. We knew it would happen at some point, and that meaning that Amazon might have earnings on a Wednesday that we had expiration. We lived through this the day before Good Friday last year with Netflix. Yep. So we've learned. So I just want to make sure, and I don't want to put words in your mouth. I believe you're both advocating we can continue to go, just don't open the floodgates. Because I still think there's room for a few more securities. We'll continue to learn. And whether we get the additional securities or whether we move to Tuesday, Thursday, we can talk about collaboratively and collectively and with extra weight, because like I said, you guys are in the trenches. But I don't want us to quote the great Stephen,
How great was it?
let's not let perfect be the enemy of the good. And I think that's what Stephen Sykes was trying to get to. But I do want to keep moving forward, but with a lot of input.
Yeah, I just want to add, I think the worst thing you can do is shut something down the second it breaks. I think there is a fatal flaw in the market sometimes in regulation where when something bad happens, we react and turn it off. And I would hate to see that happen in these products.
Maybe one point, I think, and that ties into maybe our second topic, but global trading hours expansion, that 15 minutes, I think from a risk perspective is going to really help. To your point about like the after-hour move and potentially the assignment risk. So that's going to help tremendously for managing this risk for this product. So I think those two go hand in hand.
And maybe that's what you were saying, but also I think that OCC window, like we should really talk and think about how we can narrow that. I understand there's trade adjustments and things like that, especially until we modernize the floors, but even better. But I do think there's opportunity to work with OCC.
And maybe I'll just add to that. I think that's like one of the places where the ecosystem can come together, because I think there's a variety of perspectives where, continuing to move forward with the listings, the additional expirations, while it moves the market forward, we have to make sure that we have the appropriate guardrails in place, because ultimately it's the clearing firms and the OCC that are wearing the risk of these processes as well as the individual investors. And so we need to make sure that we have the right guardrails. I think exercise and assignment processes are not seamless. They have come a long way, but there's a lot of room for improvement. And so these types of events, I think, highlight the fragility in some of those processes. And so guardrails and actually sitting down and talking through what are we trying to achieve and how do we do that safely with all parties around the table, I think could really go a long way.
I think in terms of things that keep you up at night, I guess with the majority of firms, it's like, operational risk, corporate actions, exercise assignments are the most concerning. They are still complex, which I think to a certain extent also, when we speak later maybe about, tokenization and those things, that's where I guess also the option market differs from the equity markets, and we need to keep that in mind as we develop further.
I think one thing we didn't talk about, there's ideas about how to mitigate the exercise risk, extend trading hours, move the window into a smaller time frame for exercise. Another way of looking at this that we need to talk about is possible change at Options Clearing Corporation and how you determine automatic exercise. Should it be done at the 4 o'clock closing price? That's really the trigger of this whole problem.
So Andre, you've got a growing to-do list. But at the risk of putting you too much on the spot, is something, changes to the exercise windows, that's something that's feasible or interesting?
I think it's not just at the OCC, so I think that's the importance that we have as an industry together. To the sequencing is going to be important in the overall evolution of whether it's extending trading hours or these things as well, because we have to find alignment on what is global trading hours, what is extended trading hours, when is the market closed across equity and the OCC. But it also requires on the clearing member firm side that same evolution to happen. So we obviously also observe, and we do get requests in the evening where operational work still needs to complete at our clearing firms. Sometimes there's operational issues where they request extensions. Those things, still exist and haven't gone away, and we need to keep those in mind as we try and solve these as much as we can.
Thank you.
Jim, did you have?
No, I just wanted to add, on the contrary exercise instructions, the rulemaking process always starts kind of like you get a lot of noise about something, you're hearing noise, then you have a roundtable, and usually the next step would be good if there was some publicly available data on the frequency and how often it occurs. That would kind of be helpful in determining whether the solution needs to be small, medium, or large.
Thanks. So continuing on this theme with a little difference is cash-settled single stock options. So what impact could single stock cash-settled options have? Historically, physically settled options have helped mitigate the risk of manipulation by imposing an economic cost when extracting profits from a trade. Cash settlement would remove that friction. What are panelists' thoughts on the potential for single stock cash-settled options? Start with Kevin.
Wasn't expecting that, but I'm good because I think about it a lot, and it does remove some of the friction. I do think we all know that you have to design the right kind of settlement, though, because much easier to manipulate and hurt investors than an index. So I think it's something we have to give a lot of thought to. That one, clearly out of all the things we're going to speak about today, about where I'm concerned that we're, ready, go, set instead of ready, set, go, cash settled options would be at the top of that list. It's appealing because it just sounds so attractive. Like, wow, just settle for cash. You don't have any of these problems we just spent the last 15 minutes on. But I think we'd need to tread very cautiously and really get a lot of input from everybody on all three of these panels.
Matt?
Yeah, thanks. This question prompted a lot of discussion and a diverse array of views within Optiver when I asked. I think on the one hand, it certainly is an attractive idea, especially for someone who's interested in trading volatility or hedging volatility. It removes that friction. On the other, there's a concern about drawing liquidity away from the physically settled market, and what does that mean more broadly? I have to give a shout out to Jerry Schwarbick, who identified FINRA Rule 2360. I think I got that right, Jerry. That would probably need to be rewritten if we were to do this. So a lot of operational issues involved, but yeah, definitely some interest. And I think the overall theme was potential for a rising tide to sort of lift all boats. So more options. That was not a pun, I promise. Would incentivize greater participation.
Ferris?
I don't have too much on this topic. I mean, we don't see a lot of demand from our clients in terms of cash-settled single stocks. I do recall when the Monday Wednesdays were proposed, there was an industry discussion about could we make these cash-settled because of this exercise and assignment, the pin risk that we talked about. And I think the consensus at the time, and I know it takes a lot of the friction out, but it's harder to implement. These are, from a pairing perspective in terms of the calculating margin, do you treat these as a separate class versus the physically settled? Can you spread those together between the cash and, how do you treat that? So there is a little complexity, at least from our perspective. I do think, just maybe not related to this, I think what we're seeing the demand is in flex options, and what SIBO is coming from the SIBO for our registered RIA business, where they want a European-style single stock to hedge some of their concentrated position and not worry about the assignment risk. I think that is getting a lot of traction from that side. Maybe back to the cash settled, maybe there maybe a good use case for a cash settled is potentially a binary option. And that, I think JJ mentioned the predictive market. You can really, put that as, a cash settled option is a speculative instrument versus the physical, which is the use case is to hedge. This potentially could be, wrapped in a predictive market kind of front end to the client, and can really be under the purview of the SEC, since it's a security and it's easier to implement as well. So,
Thank you. Mike?
Yes, if you think about why options exist, what are they used for? They're primarily used for either speculation, hedging, or yield generation. And if you were to drill down into current 0 DTE volumes and identify how much of that is pure speculation, then my question is simply, why not go cash settled?
Jim?
Our interest on this one is fairly narrow to just flex on flex settlement, cash settled flex on ETFs. And so we understand, obviously, on the industry side, the capital efficiency, settling cash versus a physical settlement. And, that's being balanced against, obviously, the Commission's interests around avoiding potential manipulation on pricing on the close. So, we appreciate that. But the issue that we have is that on these cash settle flex on ETFs, they have certain liquidity and trading volume thresholds that they have to hit, which is fine. They're pretty high, and that's good. So that kind of solves the problem of marking a close on these products. However, you also have this like 50 ETF cap that is causing some angst. In the last 6-month evaluation that went through with these ETFs, over 60 met the trading and liquidity thresholds, but because they were 51, 52 to 60, they weren't eligible for it. So some type of expansion on that 50 ETF cap would be helpful.
Thank you. We'll turn to the next topic, which is stock tokenization. So if stocks tokenize, including outside of the NMS system, what effect could that have on options? For example, would it make hard-to-borrow securities less accessible to borrow and therefore raise lending rates? We'll start with Andre.
Thank you. I was at an industry conference in March, and I'm not sure if I'm allowed to name the industry, but I think most of us were there as well. But I think that was a proof that the digital market infrastructure and traditional market infrastructure are converging at an accelerated pace, because I think half of the panels and half of the topics were related to that. We also know that both exchanges and CSDs are all investing in tokenization capabilities, or have done so. DTCC obtained their no action relief for a tokenization pilot covering US equities, ETFs, and treasuries. And NASDAQ has filed with the SEC to facilitate trading of tokenized securities. So if the underlying equity exists in both traditional and tokenized form, so too the options clearing system needs to accommodate both settlement paths. And this probably has implications for delivery obligations, margin collateral, and corporate actions. To answer your question, I think if tokenized shares trade outside the NMS framework, it probably means that the link between the options market and the underlying becomes more complex, and that most likely borrow costs, settlement timing, and price discovery could be affected. And these would also affect directly into options pricing and risk management. I've heard a couple of panelists also mention slow and methodical, being who we are and what we do, and I'm proud of this industry and how stable and resilient we are, and I'm proud of the OCC team in doing what they do day in, day out. So we're also taking a slow and methodical approach as it relates to tokenization. We are near-term exploring the acceptance of tokenized assets as margin collateral to improve efficiency and also look at potential expansions into 24/7 trading. We are then, for longer term, evaluating what does on-chain clearing mean and how would OCC operate in such a digitally native market structure. Thank you.
Mike.
So Apex, as a platform company, it is our job to provide access to whatever comes to market, and agnostic of what we think about the product itself. And when I think about tokenization, I view it as just another form of synthetic risk on another asset. And again, I think we need to walk before we run. I think at the OCC, if I own 100 shares of NVIDIA tokenized, and I go and I sell an upside call, I think to start out, that position should be considered holding a naked call or some pro rata share of risk. I think we need to consider what's happened in the past when we've had synthetic risk in the market, and when prices detach from parity. And what happens is we typically see liquidity events. I'm not saying that's going to happen with tokenization. I just think it's something that we need to watch. I also think that we need to watch the leverage that we're extending, right? In the crypto industry, you read about 10x leverage on various crypto assets. I think in the equity space, as we tokenize, I don't believe the intention is to allow leverage to start, but I think that we should all, maximum 2x, 3x.
know if I can just add just on that.
Yes.
I think, Matt, you raised a valid point earlier, among many, of course, about how do we think about the ownership of that asset, right? So much of what happens across the industry is done on a net basis, right? There's a significant amount of financing that's provided that's not done by kind of moving things in sequence. It's done based on providing financing. And so the question over tokenization, who has title to those assets? What do you have the ability to do with those? I think is one that needs to be answered from a variety of different perspectives. And what does that mean from execution all the way through to clearing? How does it mean how a clearing firm interacts with the clearinghouse? How do you think about the assets that you have recourse to? And then to that point, I also think it changes the risk composition potentially of the clearinghouses that are accepting these types of instruments as collateral. Does it change the way we think about non-default losses, and how do you capitalize for some of the incremental risks that the ecosystem may be taking on? So I think in that kind of crawl, walk, run, those are some of the things that we need to really think about as an ecosystem.
Yeah, and I think I want to highlight like the purpose, obviously, at OCC for any of those assets are mostly important for an event such as default and default management, which means that there can't be a question about ownership or title. There can't be a question about convertibility and the value of it. So that's why I also mentioned that, while we look at innovation and see how this could potentially help the market in terms of efficiency, it will have to be the crawl, walk, run approach.
Thank you. Now we'll part the clouds of gloom and doom and talk about something more fun, which is opportunities for growth. So earlier, I asked you what keeps you up at night. Now I'll ask what gets you out of bed in the morning as a promising new prospect. We can start with Alicia.
Great, thank you. Yeah, it's nice to switch from the kind of like dark clouds. Look, I think the ability to innovate, and even having the opportunity to have a conversation like this where we're talking about the ecosystem as a whole, and we're raising concerns about what does it mean to be a clearing broker, what does it mean to be a clearing house, and how do all these pieces come together? The ability to innovate and figure out solutions as a group, I feel like the opportunity to do that here and hopefully going forward is exciting, and that is a good reason to think about wanting to continue and kind of be a part of this ecosystem. Certainly capital tailwinds, I think that goes a long way in terms of helping us think about innovating, providing more capacity and more resources to help facilitate client growth, and certainly market structure reform, with some of the items that we've talked about as it relates to maybe changes in 60/40 rules, those types of things, allowing us to service our clients in the way that they want to be serviced, allowing us to innovate and do more. It's all really exciting. So those are some of the reasons. And it's an equally long list is what worries me.
Thank you. Kevin?
Good, because at heart I'm an optimist, but we're also paid to worry, so I worry. But always on, to us at NASDAQ, extremely exciting. Like, we want to trade 24 hours a day. We're starting in equities with 23.5. We'll be ready in December. We are just so excited, and I'm as excited, if not more excited, to do it in options as well. However, I just think it needs to be measured and deliberate, and not forever. I would just love to have the commission step in and say, guys, get this done by X. Understand when day orders are ending, understand when there's an opening cross, understanding the playbook if something goes wrong, understanding obvious error and what those rules are they different? Or does that change the timeline of catastrophic, which catastrophic, as we all know, means the different time of notification. So super excited thrilled about Always On. I just want to do that in the right way. More zero DTE, even with all the comments that we had, I make sure we continue to do that. And just an interesting fact, because I look at this all the time. So the top 55 days in history of U.S. options, equity options trading, have all occurred in the last 15 months. Like, that's an incredible number. 55. Like, as of the end of Q1, I actually think it's now 56, because I think yesterday was one of those top 55. But with zero DTE, with extended hours, with everything else we talked about, there's so much to look forward to.
Ellen?
Yeah, I would concur. I mean, there definitely is. We have a very vibrant ecosystem in the options market. Clearly, just demonstrated by today's event, we have so many interested parties, regardless where you're sitting here. We all want to move this market forward, and I think an area that's been touched upon is extended hours. Clearly, there's a lot of coordination going on the equity side, and as we look at options, it's really a natural evolution of our broader market for this to move forward. But when we do look at the equity markets, I think they're doing it in a really mature way in that they're coordinating the readiness of the SIP, the TRF, and clearing, and all of those requirements need to be in place before we can move forward. Options is going to follow, but I think, as folks know, they're fundamentally different. We've talked about the role of market makers today, very competitive, quoting millions of listed series, liquidity fragmented across exchanges, across strikes, expiries. So extending hours means scaling pricing, risk management, and liquidity provision across that entire surface. From a market quality perspective, extended hours can introduce different trading conditions, particularly in thinner underlying markets. That can lead to wider spreads, less stable pricing, and differences in execution quality, even as quoting obligations remain the same. There are also practical considerations. For example, the opening rotation still needs to occur within a very tight window, 1 minute, but at 7:30 in the morning, that's going to be very, very different liquidity conditions. Separately, the suitability of extended hours will vary across products. Broad-based products are more naturally suited, while single names introduce additional challenges, particularly around news events and event risk. As hours expand, they may also broaden participation across time zones, including international investors, as we touched upon today. So the question isn't really whether to expand hours, it's really how to do so. And again, taking a lesson from the equity markets, that coordination, linkage, harmonization across the ecosystem will be important. So we build on the current market structure rather than fragment it. I think another topic that we've heard today. We've seen this work most recently in zero data expiration. We started that in broad-based ETFs, where liquidity and price formation are most robust, and then expanding to a limited number of single-name equity options over time, as we've been discussing, and clearly there's a lot of caution about moving forward with that. We think a similar sequencing should occur in equities, where extended night trading was eventually first introduced in a limited set of highly liquid ETFs before expanding more broadly to individual stocks. That sequencing provided a stable environment to observe how these products and function over time and different conditions. Today, we already have a limited number of ETFs that trade in extended hours till 4:15. This seems to present a very natural starting point. Expanding first within these products before moving to single name supports more robust liquidity formation, price formation, and a consistent customer experience as trading hours evolve.
Thank you. Ferris?
So I kind of lost track of the question. I think it was
What gets you up?
what gets me up. So I think I look at the growth, the bullish growth from a retail perspective. It's fascinating to see new accounts adopting options. We track, the time from an account open to putting on a first option trade. Those are now days. It used to be weeks or months. You could see and you can feel from the education interaction that a lot of interest is in options. And like I mentioned in my opening statement, we are seeing younger investors trading options, utilizing options, and not just speculative on short-dated options, but using it to hedge portfolio and using it for yield with all the education that we provide. So I think naturally with this growth and the innovation of new products that are coming to market, I think it's going to be it's a natural evolution to be always on, and I think that's something that we're already offering equities overnight. I think it's a matter of time where options and equities will intersect overnight. I think it's more complex, obviously, to price options overnight and all the corporate action and the complexity, but I think we will get there. And I think the starting point with the SIBO announcing the GTH expansion, I think that's going to be meaningful and very useful, even from a trading perspective, but from a risk management perspective. I do think, to Ellen's point, I think a coordination between the exchanges is really crucial here, and I think SIFMA does a great job, getting a consensus from the exchange. But I don't think we can rely on Katie's charm for another 2 years. I think there has to be a framework that really ensures that if SIBO deems a GTH or 4 to 415 a regular trading session versus another exchange as a curb session, for example, that creates a lot of complexity for the order types that we provide to our clients, because everything's predicated on the day, time, and force. I think the definition of day would need to be evolved, but I'm very bullish on options trading for years to come, and it's an exciting time.
Thank you. Andre?
My job is obviously to worry about things, so it might not be as excited as everyone else. I am excited about innovation and some of the problems that we will be able to solve. If I think about even the more simple things, we kind of sometimes talk about things that are going to happen in the next couple of years, and we're excited about, the potential of tokenization, yet we also still have limitations today where on exchange trading days we have banking holidays, and then we collect margin up front to pre-fund that gap. So we're kind of like, talking still in two different worlds that we will hopefully be resolving. So I do get excited about those future possibilities. So our view, and we've heard from a couple of panelists as well, and we work closely with the exchanges and our members, but that the direction of continuous trading is inevitable, but the sequencing matters enormously. Options present unique structural considerations that equities do not. Options pricing depends on continuous reliable reference price for the underlying. And when the underlying markets are open and liquid, pricing models function as intended. And when equity trading trades thin overnight, the reliability of that underlying reference degrades, and with it, the integrity of option pricing. The ability of market makers to manage their books depends on a functioning underlying market and not just one that's technically open. Expiration mechanics, margin calls, and end-of-day settlement processes are all built around defined market close times. And extending or eliminating those windows requires rethinking of the entire infrastructure at the clearinghouse level, at the clearing brokers level, and at the exchanges. So this is not an argument against change. It is an argument about what we heard before, about doing the work carefully before committing to a timeline, as was suggested. The right approach is a deliberate and phased one, and I think the approach to start off with limited extended trading hours around known high demand windows with clear metrics will enable us to do so. I think beyond just going the internal coordination, we would welcome the Commission's engagement in building that roadmap with the industry, but not just in isolation form as an options industry, but actually in coordination with the equity industry, because the decisions that we make on either side influence one another.
Thank you. Dimitri?
Well, I'm very excited for the option market. I think the future is very bright. I never expected the option market to be so big. For example, if we take the notional equity option volume and divide it by the stock volume, it's between 30 and 40%. So this is just huge. And I expect to see more growth, especially from shorter maturity. I think the weekly option on individual names will be introduced, and then eventually the zero DTE options on individual names. And to me, it seems like the European version is actually very attractive because it solves the problem with the reference price. In the underlying stock, we have the closing auction, which accounts for more than 10% of the underlying equity volume, and it solves so many problems in the market. So I expect the option market to grow, and hopefully we as academics will get a little bit more data to work with.
Jim?
Yeah, I mean, listen, I think, ETFs, outcome ETFs, it's a very growing, it's large now, it's growing now. There are some, obviously, I think it's pretty easy kind of like to connect trading venues, but when you start getting into the clearing of some of these products, obviously, there's some complexities around that. ETFs clearing at NSCC and the options that are being held within them. Listen, this is a great product. What it provides as far as liquidity and pricing efficiency to equity markets. If they start doing well, the options market should be doing well on top. But I just would suggest that, if you're going to take this conversation further, that you look for some ETF representation. A lot of the growth is occurring in those outcome ETFs. They require options to deliver the investment, desire of the investor. So, things to be bullish about.
Shelley?
Thank you. A few things to consider. As an exchange, we're in a unique situation that we facilitate trading, and we facilitate trading by allowing the market makers to be more aggressive in posting their quotes. It's not for the exchanges or the clearinghouses to impose new risk on the market makers or the market in general. I think we need to think long and hard about extended trading hours. There's probably very few people in this room, aside from myself and a couple of people, who remember we used to trade equity options till 4:10 every afternoon, and we backed off at some point 4 o'clock. That was a long time ago. But as we talk about extended trading hours, I think there's a significant flaw in the CBOE proposal. The majority of obvious errors occur around the opening rotation. The CBOE proposal has 2 opening rotations. You're going to open at 7, you're going to close at 8:25 Central Time, reopen at 8:30. So now we're imposing upon the market makers 2 opening rotations that these specialists have a requirement. Maybe that's another significant reason why they should have carve-outs, but we'll talk about that. But 2 opening rotations, 2 chances at the opening for obvious errors rather. So it's imposing risk in the industry. As exchanges, we should be facilitating trading and reducing risk. Things like new risk protections, better technology, better throughput. But let's also talk about quotes, and we talked earlier about quote mitigation and strike mitigation. If we extend trading hours 2 hours a day, we're 6.5 hours now. If it's similar quoting, you're going to see an instantaneous 20% increase in those quote graphs. So there's a lot of things to think about, so we really should take our time and think through all the unintended consequences.
Thanks, Shelley. What else? Mike?
I'm excited about the international growth that we're seeing converging with the new products that we're introducing. We're seeing large growth in South America, Asia, in Europe, and the ability for them to access the U.S. market during their normal day, their market hours, providing that supply to meet their demand. I think it's great. I think everyone in this room should be proud that we have such large demand for U.S. equities, U.S. stocks, U.S. options from international clients, and that's only going to grow.
I feel like I should say something so you don't get the impression that I get up depressed every day. I would just say that as the policy person, I'm very encouraged by the dialogue and all the work and engagement that has come from the SEC's direction to the industry on these issues. I mean, the first public roundtable in more than 20 years is a great sign. And the issues or problems or idiosyncrasies that we've identified today are probably not the end of the story. There will continue to be those problems or issues. And to quote an iconic member of another dream team, just substitute Angola for problems when you hear, I don't know anything about Angola, but they're in trouble. That's Charles Barkley, by the way.
All right, before we move to our final question of the day, I want to quickly acknowledge the contributions of Arisa Kettig, Joanne Kim, other TM staff, facilities and security, the security group to help make today possible. So our last question, we'll do a kind of a lightning round to go through everybody in the last couple of minutes we have left. And this one is inspired by the poeticism of the LOMSWAG acronym. So I give you KAMSK, which is the Congressionally Appointed Market Structure Genie. If the omnipotent KAMSK granted you one wish that you could only use to improve options market structure, What would you change? And very briefly, what effect would your change have on investors? So let's start closest to me, Andre.
If I were granted a wish by the genie, I would like to see a framework that continues and further evolves the support, obviously, of central clearing, because it will truly recognize the benefit that it brings in the way that it helped support our industry and growth of the industry, as we heard today, over the last 53 years, and then, in my view, also for the growth that we have projected and the exciting things that we've heard today.
Shelley?
So I looked at this question a slightly different way. As I read it, you could only use to improve options market structure. So that options market structure depends very much on your frame of reference. So I'm going to take off my MIAX hat and put on my market maker hat. I'd like to see a trading floor. I'd like to know what I know today. Single listed equities, trades at eighths and quarters, and my acronym is BRN.
That's an old school genie.
It is. Alicia?
Thanks. I'd like to say, let's follow the risk, follow the funding, and make sure when you go through that whole chain, we have the right guardrails and protections built in for each of these components. That way the system can continue to grow in a healthy, resilient, and sustained way.
Thank you. Helen?
So as we've discussed, we've created a market structure that incentivizes competition, lowers barriers to entry, and delivers an unparalleled experience for retail investors. In many respects, that model is working. Many would say we've already captured that genie, but there is always room for improvement. In a fragmented market with 18 exchanges, it's important that we continue to promote clarity, consistency of approach, and a level playing field so all participants can compete fairly.
I'm a little disappointed in Shelley because I thought he was going to say, as a former trader like he and I both are, that he was going to wish for 3 more wishes, which is what I would have done, Richard, but you qualified it and said it had to be for market structure. So my wish, honestly, will come across a little bit self-serving, but I need to explain it. So there's something called QBTC, which is Q for NASDAQ, BTC. It's going to be hopefully, our NASDAQ index listed options QBTC. Your team has done incredible work trying to get this approved, working with the CFTC. So if the genie came out of the bottle, I'd say, can we get that done? And not just because I want it for my index suite, but because approval of QBTC would provide a clean, regulated bridge between digital assets and institutional market structure, sending a signal that we're really moving together and we're working together with both regulators. So that's really why I want it, and that would be my wish.
It's a great wish. It may be posed in the wrong building.
That's why I made a point to say I'm very appreciative of the team here. I really am.
Well, Kevin stepped on my joke, so the correct answer, whenever a genie is involved, is to wish for more wishes. So appreciate that. I think from our perspective, I'd like to associate our firm with the comments that Steve Crutchfield made this morning around lifetime appointments for specialists. I think a competitive and transparent process on specialist appointment would be my wish from the genie.
For me, I mean, I think the market structure is serving the retail investor really well. I mean, I think my wish is attainable. I think maybe a framework to break fraudulent trade that helps the whole environment cleanse the system from account takeover.
Well, Form 605 for options would be great because it will provide the objective measures of execution quality and keep us academics busy.
So I had 2, and they both were covered, Kevin and Alicia. So I guess my wish would be, you know, like those like fold-up tables that usually come with those chairs. That would be very helpful next time. You know, it's hard to take notes with.
Kind of like if they're a swim meet or something. Like
Yeah.
I don't have a wish for anything today. I have a wish for something that I think could happen in the future and how we as an industry react to it. In the future, if we have some type of volatility event as a result of artificial intelligence or a large language model that causes some havoc on the market, I would ask that we not immediately turn to overregulate and turn something off. I would ask that we examine what went wrong and not pull the rug on this transformative technology that's helping all of us.
Jamie?
Well, those are all wonderful wishes. Back to where we started today, Commissioner Peirce mentioned her wish. Thank you all and the previous two panels for helping us grant it. That's important. We mentioned performance measures. I think the division will stand well in her regard. So thank you all for this panel, for the prior two. Thanks to the commissioners, thanks to the chairman for his remarks. As Richard said, thanks to the dedicated team at the division who helped put this together. As the chairman said, this is an incredibly informative day. I think there's potentially lots of things to do, which we'll take away. Most importantly, though, it's an opportunity for us to see and hear where we might come in and support and help standardize and build on the progress, ORF and other things, where we can help you take the next steps to improve the marketplace. Once again, feel free to comment. Please comment. Comments are already rolling in. Croper had the precise file number. I'll just ask you to search on the website for options market structure roundtable and find it there. So with that, thanks again. This concludes the roundtable.